Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So it is Tuesday, June 2nd, 2026. President Trump is in the White House. And as an American investor right now, I think it is incredibly easy to get completely tunnel visioned.
Oh, absolutely. Everyone is, hyper-focused on domestic stuff.
Right, it's all domestic economic policies, local headlines, whatever the Federal Reserve is hinting at this week. But if you look at the data, there is a massive, frankly fascinating story unfolding across the Pacific.
Yeah, and it's one that completely defies conventional wisdom, to be honest.
Exactly. So right now, the Japanese currency is essentially in free fall.
Yeah.
And in any normal, textbook scenario, foreign investors should be running for the exits in an absolute panic.
They should be terrified.
But instead, they are pouring tens of billions of dollars into Tokyo at record speed. So today, we're taking a deep dive across the sea, because while Japan is breaking all the rules just across the water, South Korea is experiencing this massive boom for the exact opposite reason.
It really is a fascinating divergence. I mean, we are looking at two of the most significant economies in Asia, and they're both riding these massive waves of global liquidity and the artificial intelligence revolution. But the underlying DNA of these two rallies couldn't be more different.
How so?
Well, we're seeing this slow burn, highly methodical structural change in Japan, and that's contrasted directly against a high-speed, momentum-driven, heavily leveraged rally in South Korea.
Like night and day.
Exactly. And understanding the mechanics of how both of these work is crucial if you, as an investor, are looking to diversify outside of the U.S. market right now.
So let's start by unpacking the sheer scale of the paradox happening in Tokyo. Because recent analysis shows the yen has been hovering around 160 to the US dollar.
Which is just, it's historically incredibly weak.
Right. And the Japanese government isn't just sitting by. According to the data, they spent an astounding 11.7 trillion yen, which is roughly 73.5 billion US dollars, in May alone.
Just staggering amounts of capital.
Yeah, they're taking their foreign reserves and buying up their own currency in the open market just to try and stabilize the bleeding. And it barely made a dent. The yen slid right back down.
And that, that is usually the ultimate red flag for an international investor. I mean, the mechanism here is straightforward but brutal.
Walk us through it.
Sure. So if you are a dollar-based American investor and you buy a Japanese stock, you need that stock's price to go up, obviously. But if the yen's value drops, say, 15% against the dollar while you hold that stock,
then your gains are just vaporized.
Exactly. Any profit you made gets completely wiped out when you convert your money back into US dollars to bring it home. Currency depreciation acts like this massive hidden tax on your investments. It usually terrifies foreign capital.
Yet the reality on the ground, and we can see this in the latest market reports, is that foreign money is just flooding into the Tokyo Stock Exchange.
Oh, it's a tidal wave.
We saw 1.08 trillion yen of foreign stock purchases in just a single week in late May. That capped off 8 consecutive weeks of buying, bringing the year-to-date total to almost 12 trillion yen.
Right, so they clearly aren't running away from the currency risk.
No, they're running towards something they believe is significantly more powerful. But what is that?
They are buying a profound psychological and structural shift in how Japanese corporations operate. To really understand this, we have to look back at the post-bubble trauma.
You mean from the 90s?
Yeah, exactly. Ever since the massive Japanese asset bubble burst in the early 1990s, Japanese companies have operated with a survivalist mindset. They just hoarded cash.
Like dragons sitting on piles of gold.
That is the perfect way to put it. They were terrified of another economic collapse. So they kept millions sitting in zero-interest bank accounts. They completely ignored shareholder returns, and they ran very insular, defensive management structures.
Right. So capital efficiency was practically a foreign concept over there.
Completely. But recently, the Tokyo Stock Exchange finally stepped in and essentially forced a cultural revolution. They started aggressively demanding that companies modernize.
And the mechanism they're using is actually brilliant,
Right.
Because it taps directly into the cultural importance of reputation in Japan.
It's ruthless but effective. If a company is trading below its book value, meaning the stock market values the company less than the raw assets it holds, the exchange demands a public plan to fix it.
And if they don't?
If the management refuses, the exchange puts them on a public name and shame list.
Oh, wow. So they literally call them out.
Publicly. And that public shaming is incredibly effective. I mean, Japanese executives are terrified of the reputational damage of being officially labeled as inefficient by the exchange.
So to get their stock prices up and get off that list, they have to finally open the vault.
Yes. They are initiating massive stock buybacks, which, reduces the number of shares on the market and automatically makes the remaining shares more valuable.
Basic supply and demand.
Right. And they're drastically increasing dividends. They are also finally selling off non-core, unprofitable side businesses that they've just held onto for decades out of tradition.
It really is like looking at a massive, neglected, family-owned business that has been running on, I don't know, fax machines and paper ledgers for 50 years.
Which a lot of them were.
Right, and suddenly they hire a ruthless, modern CEO who comes in, digitizes everything, sells the empty warehouses, and actually starts paying out profits to the owners. Foreign institutions are buying that turnaround story.
And that modernization isn't just limited to the corporate boardrooms. It's happening in living rooms across Japan, too, with the NISA accounts.
Ah, right, the NISA accounts. So for an American listener, NISA is basically Japan's equivalent of an IRA or a 401k, right? Like a tax-advantaged retirement account.
Exactly. And the expansion of NISA is the second engine of this rally. Historically, everyday Japanese citizens shared that exact same post-bubble trauma as the corporations.
So they were hoarding cash, too.
An astonishing amount of the nation's wealth was just kept in physical cash or dormant bank deposits. But with inflation finally creeping back into the Japanese economy over the last year or so, keeping cash under the mattress means you are actively losing purchasing power.
Because things cost more, but your cash isn't growing.
Right. So the government essentially pushed them, saying, look, you need to invest this money to build wealth for retirement, and we will give you the tax breaks to do it.
And the adoption rate has been staggering. According to the data, by late 2025, we saw over 28 million accounts opened, with 71 trillion yen invested. They blew past the government's 2027 targets 2 years early.
It's massive. So you have foreign billions buying the corporate reform, meeting a tidal wave of domestic savings finally waking up and entering the market.
That combination creates a very solid foundation of value investing. But what transformed this from a steady recovery into a full-blown 2026 boom is that Japan is no longer just a land of old-school, heavy machinery and car manufacturers.
Not at all. They have quietly positioned themselves as a crucial pillar in the global artificial intelligence infrastructure.
SoftBank Group is the perfect example of this. I mean, they've surged to become Japan's #1 company by market capitalization.
Yeah, and that's largely driven by their aggressive AI investments and the skyrocketing value of their stake in ARM, the semiconductor-design giant.
We're also seeing domestic semiconductor design companies like Socionext experiencing massive rallies. So Japan is offering global investors a really rare combination here. The safety and value of corporate reform paired directly with the high-growth upside of AI infrastructure.
That dual narrative is incredibly attractive to institutional money. But we do need to address the structural cracks in this foundation.
Right, I want to push back a bit here, because if I'm an everyday Japanese citizen, this weak yen is a total nightmare.
It's extremely painful.
Japan is an island nation that imports almost all of its energy. So a 160 yen to the dollar exchange rate means that buying oil and natural gas on the global market is excruciatingly expensive.
And that cost gets passed directly to the consumer.
Exactly. The inflation might look like a healthy metric on a central bank spreadsheet, but at the grocery store and the gas pump, everyday people are getting crushed because their wages just aren't rising fast enough to cover the imported inflation.
And that reality places the Bank of Japan, the BOJ, in a tremendously difficult position. I mean, they were walking a tightrope. To strengthen the yen and relieve the pressure on the everyday consumer, the Bank of Japan needs to raise interest rates.
But higher interest rates make borrowing money much more expensive for corporations.
Right, which is kryptonite for high-growth tech stocks.
Because when rates go up, the cost of funding future innovation skyrockets, and investors discount the value of those future earnings.
Yes. So if the Bank of Japan is forced to hike rates aggressively to save their currency, they risk strangling the very tech and AI rally that is drawing all this foreign capital in the first place.
A catch-22.
Exactly. The BOJ has to provide a very delicate, highly telegraphed path for their rate hikes this summer, or this entire Japanese market renaissance could face severe turbulence.
Okay, so if Japan is the story of methodical, government-mandated reform attracting foreign capital, Let's look just across the sea,
Mm.
because South Korea is proving that you don't need institutions at all if you have enough everyday people trading on their phones.
The contrast is just jarring. It is a completely different financial ecosystem over there.
The numbers are wild. Based on the latest market reports, the KOSPI, which is South Korea's primary stock index, rocketed up 28.5% in May alone.
And that surge is dangerously concentrated. Just two companies, Samsung Electronics and SK Hynix, now make up over half of the entire market capitalization of the South Korean exchange.
Over 50%. In two memory chip makers. And the wild part is, when you see a market jump almost 30% in a single month, you naturally assume the massive global hedge funds are pouring money in.
But they aren't. Institutional foreign investors actually sold record amounts of Korean stocks in May.
They took their profits and left.
Exactly. The engine driving the KOSPI to all-time highs right now is entirely fueled by South Korean retail investors, everyday people using heavy leverage.
The scale of the retail participation is just staggering. We are seeing trading volumes in single stock leverage ETFs surpass 9 trillion won.
And for anyone unfamiliar, these are complex financial instruments designed to multiply the daily returns of one specific stock.
Right, so because they're using leverage, they're basically playing with the broker's money.
Yes.
You put in $1,000, but you borrow enough to get the market exposure of $3,000. So if the stock goes up 2%, you make 6%. Feels like free money.
But the math works both ways.
Exactly. If the stock drops 2%, you lose 6%. It really is a tale of two completely different mindsets.
Yeah.
You look at Japan, and it's like buying a neglected house and slowly renovating it to build equity over years.
And then you look at Korea.
Yeah, and it's basically day trading a meme stock on margin. I mean, it is pure, unadulterated momentum.
The psychology driving this momentum in Korea is highly specific too, because they aren't just buying these companies because they manufacture standard memory chips for data centers. The Korean retail market has become entirely obsessed with a narrative called physical AI.
Which is a crucial distinction. We aren't talking about generative AI that lives in the cloud, writing emails or generating images on a laptop.
No. Physical AI is the transition of artificial intelligence into the real three-dimensional world.
We're talking about factory automation robots that can adjust their own manufacturing lines in real time. We're talking about autonomous logistics networks, self-driving vehicles, humanoid robotics, and smart home appliances that actively manage a household's energy consumption.
And the retail market over there is desperately trying to identify which companies will dominate this physical integration. And that desperation makes the market incredibly reactive to any perceived catalyst.
Oh, like the dinner party.
Exactly. On June 1st, at the Computex event in Taiwan, NVIDIA CEO Jensen Huang hosted a private Korean partner night. He had dinner with executives from SK Hynix, Samsung, LG Electronics, and Naver.
And the market absolutely lost its mind. Just the news of that dinner sent stocks like LG Electronics skyrocketing the next morning. But I have to inject some reality here, because going to a dinner party with the CEO of NVIDIA does not mean you just signed a billion-dollar contract.
No, it certainly does not.
It feels like investors are confusing a handshake and a photo op with a peaches order.
You are identifying the exact danger zone of a momentum market. I mean, in an environment driven by retail leverage, the line between tangible revenue and speculative hype completely blurs. You have to look at the underlying mechanics of the products to separate the two.
Let's use SK Hynix as an example.
Great example. They manufacture high bandwidth memory, or HBM chips.
Right, and the mechanics of HBM are vital to understand. Instead of laying memory chips out flat on a motherboard, which takes up space and slows down data transfer, HBM stacks the chips vertically, like a skyscraper.
And NVIDIA physically requires those specific stacked chips to run their most advanced AI processors. That isn't a rumor, that is a supply chain reality.
So SK Hynix is generating massive tangible revenue because they are selling the absolute best pickaxes during the AI gold rush.
Exactly. That is fundamental earnings growth. But then you look at other companies in the smart appliance or consumer electronics space whose stock prices are pumping 15% in a day, purely based on the hope that attending a dinner might eventually lead to a partnership in the physical AI space.
The price is inflating because retail traders are buying the rumor, front-running what they hope will be an announcement.
Right. And if you don't differentiate between a company with a signed HBM supply contract and a company that just secured a dinner reservation, you are exposing your portfolio to massive downside risk.
Which brings us to the macroeconomic reality check for South Korea. The momentum is fun on the way up, but the structural headwinds facing their economy are severe.
Very severe.
According to the data, in May, Their consumer price index, the inflation rate, hit a 2-year high of 3.1%. And just like Japan, Korea has to import its energy.
The geopolitical tensions in the Middle East have caused a massive spike in oil prices and international shipping and flight costs. That external pressure is driving up the cost of living rapidly in Seoul.
So what is their central bank doing about it?
Well, the Bank of Korea temporarily froze their interest rates at 2.50% in late May, but the market consensus is aggressively pricing in rate hikes by July or September to combat this imported inflation.
And this is where the leverage becomes a ticking time bomb.
Yep.
Because if the Bank of Korea hikes interest rates, borrowing costs go up and the stock market naturally dips.
Yep.
When a market dips, a retail trader holding a heavily leveraged position is going to get a margin call. The broker sees the account value dropping, calls the trader, and essentially says, the stock you bought with my money is losing value. You need to deposit more cash right now to cover the difference, or I am forcefully liquidating your position.
And because this rally is so retail-heavy, a massive percentage of the market is exposed to that exact scenario.
Just a domino effect waiting to happen.
Exactly. If thousands of retail investors get margin calls simultaneously and don't have the cash on hand to deposit, the brokerage algorithms automatically sell their shares at market price.
Which tanks the price even further.
Yes. That tidal wave of forced selling drops the stock price, which instantly triggers the next layer of margin calls for other traders. It creates a brutal, cascading market crash. The leverage that drives the market up 28% in a month can tear it down twice as fast.
Wow. So, synthesizing all of this, how does an American investor actually apply this knowledge to their own portfolio? Let's put these two markets side by side. What is the play?
Well, if you are looking to allocate capital to Japan, you should treat it as a long-term core holding. You are buying into a multi-year structural transformation of corporate governance. You are buying the fact that companies are finally prioritizing shareholder returns.
But you still have to navigate the yen.
Absolutely. To protect yourself from the currency depreciating and eating your profits, you utilize a currency-hedged ETF.
How does that work?
These are funds that buy Japanese stocks, but they simultaneously use financial instruments to essentially take out an insurance policy against the yen dropping against the dollar. It neutralizes the currency fluctuation, allowing you to capture the pure performance of the Japanese businesses.
Got it. So you get the upside of the corporate modernization without the anxiety of the foreign exchange market. And what is the strategic play for South Korea?
South Korea must be treated as a high-risk, high-reward growth allocation. It is highly volatile. If you want concentrated exposure to the AI memory chip supercycle, the opportunity is undeniably there, but you have to do the rigorous fundamental analysis.
You can't just buy the index blind.
No, you must separate the companies that are physically printing money from HBM contracts, from the companies that are just riding the retail meme stock wave.
It really boils down to intent, doesn't it?
Yeah.
In Japan, you are buying the reform. You are buying a systemic turnaround. In South Korea, you are buying the sheer speed of AI innovation, but you are strapping yourself into a roller coaster driven by retail leverage.
That captures the dynamic perfectly. And stepping back to look at the broadest possible picture, I think the most important takeaway here is about recognizing your own blind spots.
What do you mean by that?
Well, under the Trump administration, with so much focus on domestic economic policy and the sheer gravity of the American tech sector, it is incredibly easy to suffer from severe home country bias. You might look at your portfolio and realize you are entirely concentrated in U.S. equities.
Which feels totally safe right up until the exact moment it doesn't.
Precisely. If the AI boom in America begins to cool off, or if domestic valuations simply become too stretched to justify buying in at these levels, you need alternatives.
You need a backup plan.
Right. And these Asian markets, one undergoing a historic government-backed corporate renaissance, and the other driving the physical, real-world application of artificial intelligence, could provide the exact diversification safety net a U.S.-heavy portfolio actually needs. Ignoring them simply because the headlines are focused domestically might be the biggest macroeconomic risk you can take right now.
It is a completely different landscape out there and a great reminder to thoroughly understand the mechanics of what you are buying, not just the momentum. Don't forget to subscribe and hit that like button.